Hedge funds were originated by A.W. Jones in the 1960s, and he adopted the performance fee that a sea captain would have received for taking a cargo around the Cape of Good Hope. The standard fee was 20% of the value of the cargo. But there, the sea captains were risking their life to take these the ships around the Cape of Good Hope. A.W. Jones copied that kind of template, but he also introduced a management fee. And his successors have been very lucky that that's the way he chose to start it, because 2 and 20, which is not now customary, but even 1.5 and 20 or 1 and 20, that is too big a slice of the total pie. And if you look at what markets over the long term are likely to give you, and you incorporate a certain amount of alpha, an ability to outperform the markets, both on the long side and on the short side, you have to make some very demanding assumptions before the owners of the money receive a better return than they would have done from the same assumptions being applied to a long-only
Guys,
portfolio.
let me tell you a 30-second story, and I promise you won't regret it. So when I started to take investing seriously, I really didn't have anyone to discuss my ideas with. I knew no one in the investing space, and therefore my process felt kind of lonely and very slow as well. So I went on and found a community of serious microcap investors, people that actually like doing the work. And I'll let you in on a little secret. It's called microcapclub.com. Members have profiled more than 1,300 companies, and over 300 of those have gone on to become multi-baggers. That's the power of this group. The awesome thing is that you'll get exposed to ideas well before institutions ever notice them. And if you want to find great businesses and surround yourself with some of the best investors in the world, head to microcapclub.com and consider applying to join or becoming a subscriber. That's microcapclub.com. Nothing in this conversation is financial advice. I may hold positions in some of the companies we discussed or have other interests. I always aim to stay objective, but please take everything with a grain of salt and do your own research.
What do I need to understand about your earliest days to understand who you are today?
Well, good question. As a value investor, I think early days are very important. In fact, very early days, because I think that it's in the blood. And I think value investors are born rather than being made. And they then develop skills, and they learn how to do it better, and they acquire knowledge on the way. But I think it's very much in the blood and in the character to be a value investor. So when you ask about early days, I won't go back to sort of pre 10 years old, but at the age of 15, I started being interested in shares. And when I was looking at share prices, I was always interested in very low share prices. That was a very unsophisticated thing to do, of course. And I had no idea at the time that what I was doing was looking at penny shares. But I had a kind of instinctive feeling that if something was priced at 6p, you could lose 6p, but you might make 18p. And so I was attracted to low prices. At that stage, I had no idea about valuation. That came much later. But I was always drawn to, in the curmudgeonly and mean way that value investors are, I was drawn to things which look cheap. And I learned as time went on that sometimes there's a good reason for them to be cheap, and sometimes there's something waiting to happen. There's an opportunity.
Did you have anyone in your family that was kind of into stocks, or was it just like randomly? Because I guess there was no internet back then, right? So you couldn't just go on YouTube and find someone talking about stocks like I can do today.
You could not. I mean, things were, by today's standards, they were just amazingly undeveloped, unsophisticated. The facts arrived after I'd started work. When I first started work in 1977, we relied for information on telexes. And there was a great shortage of information, and half the job was trying to acquire information, completely different from now, when I think half the job is rationing the information and deciding what you need to focus on and what will be a distraction and a sort of cause of delay. But back then, the sources of information were very limited. I did have my father was a stockbroker, But I don't think he pushed
Mm,
me at all towards investment. If anything, the reverse, because I don't think he really enjoyed it very much. He liked writing poetry, really, and essays.
okay.
Um, so I don't think I copied him. I just had a sort of, I had an inherent interest in investing from, as I say, a revoltingly young age, from about the age of 15.
That's really interesting. And so, did you grow up in London? For the people that don't know this, you're based in London right now. So I'm just curious.
I was born in London. At the age of
Mm.
5, I went to Jamaica for 2 years
Oh, okay.
because my stepfather was in the British Army and he was
Mm.
seconded to the 2nd Battalion West Indies Regiment. So we went off to Jamaica on a banana boat. And I love Jamaica, and
Wow.
it's been it's a place that I still really love, and I've been back about 4 or 5 times. In fact, we are due to go in 2 weeks' time, but I don't think it will be possible because of the hurricane and recovery from the hurricane.
Mm.
And then when we came back from Jamaica, I was 7 years old or 8 years old, and we moved to the country, to Essex, and I grew up for the remainder of my teens in Essex.
Perfect. Got it. And so you traveled by boat to Jamaica?
Yes, yeah.
How long of a trip was that?
I think it was about 8 days, 9 days, something like that.
Okay. Okay. That's not as much as I expected. I thought it would be like 1 month or something.
No, it wasn't. It wasn't
Yeah,
as much as
that
that.
it's just interesting. It's such a different world from what I grew up in. So,
Well, I mean, the
yeah.
amazing thing is, if you read about investors in the 20s and 30s, of course they did. If they wanted from Britain, they wanted to invest in America. They traveled by boat. These were very, very long research trips that they took.
Yeah.
Um, and no, it's very, very different now. And the immediacy of everything now is so strikingly different. And I think that creates an inefficiency in markets because everybody is so short term. And you have thousands of people who flock to their desks every day and they focus on what's happened to stock prices yesterday and to earnings announcements yesterday. And there's a tremendous pressure to do things all the time because of this flood of information and all the cacophony of noise. And to me, the great battle in investment is to keep your distance from the market and to resist those sorts of pressures. And I've always wanted, therefore, I always wanted to have an investment management operation. I used to say in Battersea, in a garage in Battersea, because I happened to own a garage in Battersea at the time. But keeping your distance is the sort of Omaha principle. I think is so important when you have, as I say, this cacophony and temptation and sort of pressure to do things all the time. And it's so often right to do nothing.
Yeah, of course. I love that garage story. Um, anyway, I really wanted to ask you a question about something you said in a presentation at Ivy Business School in 2018, if I'm not wrong. So you essentially were talking about the tech boom and the dot-com bust and so on. And you said that you believed at that time, of course, that it was unlikely that in the future there would be such a polarized market or environment. And I'm wondering if you still feel the same
Well,
now
that's
that
very
maybe we're experiencing something similar.
I think that's so interesting. I'd forgotten that I said that. I think we are experiencing something similar. In fact, I mean, I think it's so strikingly similar. You have now companies which have gone to stratospheric valuations, which make no sense. And because not everybody, there
Hmm.
may be some companies which can justify their current very high valuations, but not every company across the whole broad swathe of AI, for example, can justify the market capitalization that it's got, can justify the capital investment that it's making. And so I do think it's really similar because on the other hand, you have companies which have been largely ignored, which are trading at very low valuations. So I think I got more involved in our business at the end of last year, and I feel I couldn't have timed it better. It's such an exciting time to come back to being active again, because there's just masses of opportunity. And I think this is a good way of expressing it. On the one hand, you've got companies which have only to have a whiff of AI about them, and immediately their share price shoots up by 30 or 40%. You have companies which own real estate in Texas, where the land is valued at $1 million an acre, and this is industrial development land. You have companies which own a stash of Bitcoin, which go to and have no other business, and which go to a 30 or 40% premium to their net asset value. On the one hand, you've got those. On the other hand, you've got companies, investment trusts, closed-end funds trading at a large discount to asset value. You've got conglomerates like Jardine Matheson or Ayala Corporation in the Philippines trading at a huge discount to net asset value. You have pub companies in the UK, and I'm a chairman of a pub company in the UK called Shepherd Neame, trading at in our case, a 60% discount to net asset value. So you've got this tremendous dichotomy, this bifurcation in markets. And that is so similar to the beginning of 2000, when then the old fuddy-duddy companies, nobody was interested in. They were taken out of the indices. The FTSE index lost companies like Whitbread and half a dozen other traditional companies in favor of Baltimore Technology and I forget what else. 6 months later, they had to reverse it because those index committees work wholly on the basis of relative market cap. And 6 months later, after March 2000, the share price of the tech companies had gone down by 25% or more. The share price of the traditional companies had gone up by 25%. And so they reversed it and they put the traditional companies back into the index. Well, I think we're going to see something similar because I think these AI companies are, it really is, who's that cartoon character who walks out over a cliff? I've forgotten what he's called. No, do you know the one I mean? He's running.
Yeah, I know, but I also missing the name.
He's running and he keeps on pedaling, but he's in thin air because he's run off the edge of a cliff. And I feel that that's what we've got now.
Yeah.
We've got a bit of a sort of emperor no clothes syndrome. This is not to dispute the wonders of AI. AI will do fantastic things, but not every company which has the faintest whiff of AI about it can justify its level of valuation. I was looking, and in fact, I quoted in our last newsletter a man called Scott McNeely, who was the chairman of Sun Microsystems. And he said in 2002, roughly speaking, I'm paraphrasing, he said 2 years ago, at the height of the tech bubble, our stock, Sun Microsystems, was trading at 10 times revenues. To justify that level of price, you need to grow at 10%. You need to grow at a big rate for the next 10 years. You need a gross profit margin of 100%. You need to have no expenses to justify that level of valuation. And he said, what were you thinking to the investment community? It's not anything necessarily wrong with the business. In fact, Sun Microsystems did not survive very long after 2002, and it was bought by KKR eventually in 2010. But it's not necessarily anything wrong with the business. The problem is the pricing of it, and that's what I think we've got now. And so that's very dangerous and very worrying. And I think people are going to get very burned.
What are 3 maxims you can give us, 3 or whatever, how many you want, that we should follow at all costs during market crashes and bear markets? Because of course you have much more experience than I'd say most of the people listening to this when it comes to crashes.
Well, I think that once you're well into the crash, and of course that's a big leap. We don't know there's going to be a crash, but I'm quite worried that we could have quite a severe decline in large parts of the market, and at the same time, not a decline in the parts that I've talked about, which are languishing at very attractive valuations. But supposing we do get some sort of a crash, well, Howard Marks, I think, is so good on risk. And one of the things he says is that it's not just very expensive things, which are too expensive to justify the risk. You can also have a degree of cheapness, which is too low to justify the valuation. I meant to justify the valuation. And I mean, he is a wonderfully flexible investor who, and the point of this point that he makes about risk is it works in both directions. You can have periods in which the prospective return, if you keep your your hard hat on, and you keep your wits and you've got some courage, the prospective return is very large, and the risk is not as great as it appears. One of the nice things about value investing is that I think that value is itself a risk mitigator. Sometimes it doesn't seem like it, but the very fact that you have a low valuation means that the ground doesn't open up in front of you in quite the same way that it can if you're investing in very highly valued stuff. And I always feel that if you go to the growth table in the investment casino, you're at a table where the banker is taking a quite disproportionate amount of the chips away from you. If you go to the value table, then you have a banker who is just gently pushing money in your direction. Not an awful lot, but the odds are in your favor because valuations are low. So I think what I would remember in a crash is that there's a point at which things become severely undervalued. Nothing goes on forever in life. Nothing painful goes on forever, and nothing pleasurable goes on forever.
That's correct. That's really interesting. And the other side, obviously, we can kind of control our own behavior, or try to, during crashes. But I'd like to understand your take on the general market behavior when it comes to sustained down markets, especially in the ETF world, because we've had an unusual last decade or so, or a bit more, when it comes to returns from the S&P. So yeah, just maybe I'll throw you this question, which is a bit messy, and let me know what you think.
I think indexing is a big problem because you've had this money flowing ever more into indices, which are very, very concentrated. We run in our firm very concentrated portfolios, 20 to 25 stocks, and some clients worry about the degree of concentration. It's nothing like the degree of concentration that there is in the indices, with 7 or 10 stocks constituting 30 or 40% of the S&P. So I think that is a major problem. And if indexing reverses, the flow of money will be out of those very large stocks. I'm favorable for us, but it could be quite a dramatic move.
Yeah, that's what worries me a bit, is that people almost take it for granted. You see, for example, I went to the barber last month or something, and even he invests in indexes, and he doesn't know anything about like investing and finance. And so I'm not saying it's bad that he's investing, it's actually wonderful, but the fact that he's taking it for granted, oh, it goes up 6% every year, I think that's dangerous. What's your thought?
I quite agree. I mean, I was in the gym yesterday, and I was talking to two young guys, both of whom trade, but they had no real interest they had no interest at all in the companies which underlie their trading. They were treating this as just might have been a sort of mouse running around a room, with no interest in the mouse. They
Yeah,
were only
yeah,
interested in the fact that it moves. And I think when
exactly.
you get to that stage with a sort of confidence that it's generally going to move up, that's quite dangerous.
Hmm. And do you run into that often? So let's say you meet someone that isn't in the industry or isn't very familiar with investing, and they hear you are in the asset management business and you're an investor, and they start talking to you about their investing. And what's your general reaction to that? Because I feel it's, in my personal experience, it's pretty hard to have a conversation because it almost feels like we're talking two different languages, like if he's not a value investor. So what's your experience with that?
I think very often, because value investing is a particular language, if somebody's not interested in value investing, then they're not speaking the language and won't understand the language. As I said at the beginning, I think value investing is very much in one's blood. It's part of one's character. And there are people who, and this is not to say that other ways of doing things don't have any validity. I know growth investors who focus first and foremost on growth, and then only secondarily, and in some cases hardly at all, on valuation.
Hmm.
And some of them are very good. There are lots of ways to skin the cat. But value investors focus first on valuation. And of course, you want to invest in companies which are essentially sound, but valuation is absolutely key.
Mm. And besides valuation, what sort of criteria do you use when selling? I'm assuming you use valuation. I don't know if it's even a factor, but when selling a core holding of yours.
Well, there are all sorts of sales. The best sort of sale is when you have a price target, which is the combination of a multiple or a formula of some sort,
Yeah.
and a variable. The variable might be earnings or cash flow, or return on capital, but that produces an upside for the stock. And of course, that changes over time because the variable varies. And if everything is going swimmingly, the variable keeps on going up. You apply the same multiple and you get a higher price and you hold forever. But life is not generally like that. And so if you reach your upside target, either because the stock moves a lot or because the variable can move down, then that's a sale for us.
Mm.
And that does apply that applies when the variable moves down as well as when the variable is moving in the right direction. So if things are going wrong and earnings and cash flow and so forth are going wrong, then that may produce a sell. When a company doesn't fulfill the potential which we thought it had at the beginning, and so the story has to change, we don't automatically sell. Some people do. If they invest for a particular reason and the reason doesn't transpire, then they will sell automatically. But we reassess and we see whether the current valuation still allows for considerable upside or not.
Mm.
So we have more flexibility than some in that way.
Got it, got it. And so, Richard, you've had like a very long and fruitful career in investing, and I'm just wondering whether you have learned something new recently that changed your view on something related to investing, like either your process or criteria. Because I'm just curious, how can the knowledge be so like cumulative, and even Warren Buffett says he's still learning and stuff. So yeah, I'm just curious about that.
Well, I mean, I've learned I learn something every day or at least every week. But I'm not. I find it hard to put my finger on the sort of big lesson that I've learned
Right,
recently that changed my view about things.
of
Um,
course.
uh, I haven't got a ready answer for that.
Got it. Yeah, I guess the answer is that the improvements are kind of incremental and it's hard to notice a
I
big
think
one,
that's
but
right. I think
yeah,
that's right.
makes sense, makes sense. Yeah, for some reason we're always looking for that big thing that will change everything, but I've learned that maybe things aren't that way. Yeah.
No, I think there isn't. There's not a silver bullet which we're waiting to find, which will make us be impeccable investors in the future. We still stumble into value traps. We try very hard to avoid them, but I think they're the occupational hazard of the value investor. Yeah, we trip over as many things as we ever have done.
For sure, for sure. And so, when studying your talks and presentations and all of that, you mentioned a couple of investors that I had never heard of. And so, I'm really curious to know what's your Hall of Fame of managers, of fund managers. And maybe if you could include also some active ones, like currently active, would be awesome.
Well, okay, I'm not sure I'm going to be able to do the. Yeah, I can do the currently active. I'm afraid they're all men. The four that I'm thinking of. Uh, First of all, the sort of super saint Warren Buffett, who
Okay.
um, uh, who we all worship, and we needn't really say any more about him. We all worship him.
Yeah.
But the two that are less well known, or at least one is certainly less well known, that I would point to are Howard Marks and Peter Cundall. Howard
Mm.
Marks I've mentioned. What Howard Marks writes, particularly about risk, I think is wonderfully good, and he is flexible. He's written a lot about coming to terms with the changes in markets over the years, and as I said earlier, recognizing that some things may be just too cheaply valued, and that risk can be there can be a very low risk in investing in something which is very cheaply valued. So Howard Marks is one, and he's written several books. But one is it called the most intelligent? I've forgotten what it's called. I've forgotten
Yeah.
what it's called. It's the most something, the most
The most important thing.
important things. That's it. Thank you.
Yeah.
And then the other I would mention is Peter Cundall. Peter Cundall was a Canadian investor who died in 2011. He had a very successful business in Canada, investing globally. There's a book about him written by Christopher Risseau-Gill called There's Always Something to Do, which was
Mm.
his motto. His other motto was patience, patience, patience. And he was the epitome of patience himself. In 1999, he'd been doing it for 25 years. And towards the close of the end of the bubble period in 1999, he had 25 years in which he had underperformed the market. In the next 6 years, he zoomed. And the result was that in 2006, he had one of the best records, long-term records, 31 years or so, that there was. And so he was the quintessential value investor. He had tremendous courage in sticking with a portfolio in 1999, which he thought offered enormous value, but which was deeply, deeply, deeply out of fashion. And he was prepared to put up with a lot of suffering, which, of course, is another meaning of the word patience. The Latin word means to suffer. And he also had a great passion for investment. So I like the word patience because it has these three meanings: being prepared to wait, suffering, and having a passion for what you do. And Peter was a tremendously courageous guy. He got a disease called, so obscure that it's called Fragile X, and he died from it in 2011. And he was just as brave in facing up to his death as he was in investment management. Well, no, I think
Mm.
a life and death thing it requires more courage than investing.
Yeah.
But he was a very brave investor. He used to go
Yeah.
every year, at the end of every year, he used to make a point of visiting the market in the world which had done worst in the previous 12 months.
Really.
Yeah.
Wow. That's really interesting, and it takes kind of, yeah, a willingness to do it, because I guess sometimes it's in a remote country, right?
Sometimes it
Um,
was very remote. Yeah.
that's so interesting. Um, and speaking about fund management, I also wanted to get into fund structures and fee structures, because I know you have done a lot of thinking about it. So, what's the gold standard for fund structures and for fee structures as well when it comes to the client, of course?
Well, I think the client's interests are best served by simplicity. So straightforward, long-only fund with a management fee and no performance fee. When it comes to structure and the facility for managers to do different things, there are, of course, many people who are very good at shorting stocks, but shorting stocks is, in principle, much more difficult than being long of a stock because it requires you to be short-term. And investment in equities is not a short-term business. You need to have a long-term horizon. But if a stock goes against you when you're short of it, the position gets bigger. And so then you have to introduce stop-loss procedures and that kind of thing, which are anathema, really, or should be, to the value investor. The idea that you are forced to buy back something which is more expensive than it was before you sold it short in the first place. And then those sorts of tendencies tend to creep across into the long side of the book, so that you then have short-termism introduced into the long side. So I think that hedge funds face a problem of principle, that shorting is extremely difficult to do, and it's sort of inherently unsatisfactory. There's no other department of life in which you can sell something that you don't own. If you can only sell a house you own. You can only sell a bracelet you own. So that's structure. I think long only is superior to hedge fund. And as for fees, the fees that hedge funds and also private equity and venture cap charge, in my opinion, take up far too large a slice of the pie of total return. Hedge funds were originated by A.W. Jones in the 1960s, and he adopted the performance fee that a sea captain would have received for taking a cargo around the Cape of Good Hope. The standard fee was 20% of the value of the cargo. But there, the sea captains were risking their life to take these ships around the Cape of Good Hope. A.W. Jones copied that kind of template, but he also introduced a management fee. And his successors have been very lucky that that's the way he chose to start it, because 2 and 20, which is not now customary, but even 1.5 and 20 or 1 and 20, that is too big a slice of the total pie. And if you look at what markets over the long term are likely to give you, and you incorporate a certain amount of alpha, an ability to outperform the markets, both on the long side and on the short side, you have to make some very demanding assumptions before the owners of the money receive a better return than they would have done from the same assumptions being applied to a long-only portfolio. Somebody a while ago, Terry Smith, in fact, well-known UK fund manager, did a calculation on the amount of money that the owners of the money would have made and the managers of the money would have made if they'd invested in Berkshire Hathaway in 1965 and then reinvested all their fees in Berkshire Hathaway. And the answer is, and I forget the exact figures, but the owners of the money made X, and X was a very respectable amount because Berkshire Hathaway performed so well. But the managers of the money made 9X over that period. And in fact, there was a book by a guy called Simon Lack, which is called The Hedge Fund Mirage, in which he tots up all the profits that have been made by hedge fund managers since the beginning, which takes us back to 1965, and also all the profits which have been made by the owners of the money invested in hedge funds since 1965. And he found that the multiple was very similar. It was roughly 9 times the amount of money was made by the managers than made by the owners of the money. So I think that hedge funds are unsatisfactory. That's not to say there aren't some people who are fantastically good at doing what they do and who merit investment in their funds, even with these extraordinarily high fees. But it's very difficult to pick them in advance. Past performance is not a good guide to future performance, etc. It's very difficult to pick them. And so I've always been extremely cautious at that area of the market. And I think with private equity, the same is true. There have been studies which show that if you leverage the S&P to the degree that private equity is leveraged, then the return of private equity is no better than the S&P, maybe worse. I also think private equity is very damaging in lots of ways. Um, the water companies in the UK have been a complete disgrace, dumping sewage into the sea and into rivers. Many of them are owned by private equity, which has not invested enough capital in the business. It stripped out as much cash as it possibly could. And it's sort of obvious up front that private equity with a 5 to 7 year time horizon is not well suited to a long-term infrastructural project or industry like the water business. They've been responsible for an awful lot of the retail casualties on the high streets of the UK. So I think private equity is not societally a very good thing. They have extraordinary privileges in having carried interest tax as capital gain when everybody can see perfectly well it is actually income. It's the same as a performance fee. And then finally, they don't perform better on average than long only managers or at least the indices on average. And again, of course, there have been wonderful examples. The top quartile of private equity managers has made investors a hell of a lot, but it's not all that easy to pick them in advance. And there's a bit of sort of self-perpetuation about some of the venture cap managers, where companies wanting to do an IPO will all want particular venture cap before pre-IPO, early investment, will want particular venture cap managers like Sequoia and so on to be in there. And so the very best companies are picked off by Sequoia. And so there's a bit of self-perpetuation of good returns there, but for a very limited pool, a sort of club of investors, because they become very popular and difficult to get into. So all in all, back to structure, your question, structure and fees, I believe in simplicity. I believe in straightforward, long-only portfolios. I totally believe in equities, have faith in equities for the long run. And I believe in moderate management fees and no performance fee.
I love how you say that with a smile. I believe in equities, because you also did that in the other presentations when like you were talking and you said you believe in equities. You always put that smile, so it's interesting to note that. Yeah, definitely private equity is scary, especially in the amounts of debt they are deploying at scale, like all over the world. So yeah, I'm just interested in seeing how things play out in the next 5-10 years
Well, you've
when
got
it
this
comes to
very
that.
strange sort of phenomenon now that there are all these continuation funds which are buying the assets which are already in the predecessor funds, and so
Hmm.
giving a valuation mark, and very often a valuation mark up. I think I read that something like 30% of deals in private equity recently had been sales of assets to continuation funds run by the same managers. That's a quite scary figure, I think, if that's if that's what they now have to rely on for an exit. I
Hmm.
think it's worrying.
Yeah, definitely. And also, I think I'm not sure if you were there for the Andrew Brenton presentation in Lisbon, but he spoke about like this thing called capital calls. For people that might not know this, the investors are required to send in capital when there's like capital calls from the PE fund. And so yeah, some people are actually using debt to fund those capital calls that then are employed by the PE funds and leveraged to buy leveraged assets. So I think that's like leverage on top of leverage on top of leverage.
Well, I think one of the things which hasn't really been enough kind of explored about private equity is if you've got a small amount of private equity, 10%, 15%, then your undrawn commitments are not going to be a huge percentage. And you can afford to fund them from sort of spare cash and liquid assets that you want to sell.
Yeah.
But if you've got 30% in private equity or 40% in private equity, your undrawn commitments are then very chunky. And you can't afford to have the amount which represents those undrawn commitments fully invested in equities, for example. You have to have some cash available to meet the calls,
Exactly.
or you're forced to do what you just described, which is to borrow. And if you have to keep the cash available to meet these undrawn commitments, then I think the return of private equity that ought to be measured ought to include that cash, but it never does. Because the cash is a necessary part of the private equity portfolio viewed as a whole.
Yeah, exactly. I think that was exactly the point uh, I was trying to understand, but you said it in such a simple way.
Well, I think
Awesome.
probably Andrew Brandon probably made that point, and I've forgotten that he made it.
Yeah, probably. Um, yeah, but I wanted to talk about this anecdote from the conference because I think this guy called Luis from Mapfre, he's like a Spanish fund manager,
Yeah,
was giving his presentation. He was like happy and all about it, and then he shows a slide where your book shows up. Simple but not easy,
that makes me
and
smile too.
yeah, and it's funny because I really think he didn't know you were in the audience as a participant. So yeah, I immediately looked at you, and yeah, it was interesting.
It's
Um,
always nice for a writer when the book gets a puff.
yeah, exactly. So I'm curious to know what's your experience as a writer. Like, what were your motivations for writing a book, and yeah, what have you learned from that experience in general?
Well, I tell you one thing I've learned. But to answer the first question, why did I write it? Well, I wrote it because I like writing, and because I'd accumulated a whole lot of very strong feelings about investment over the years, and I wanted to get them off my chest.
Mm.
So that's why I wrote it. But what I've learned from it, because I did the audible version, I very conceitedly, I thought that I would read it much better than an actor would. And so the publishers said, we can get a narrator to do this. We'll get an actor to do this. And I said, no, I'll do it. So I sat in a sort of booth, which is like a telephone kiosk, with blankets all around and a big microphone and a table and the book. And I read for, I think, 3 lots of 5 hours or 5 lots of 3 hours. And I tell you what I learned. I learned how incredibly boring it is to read your own book aloud. And every author should be made to read their book aloud to themselves, because it's a very good discipline to spot all the repetitions and the sentences which are much longer than they need to be and all that kind of thing. So I've learned that about writing.
Yeah, that's really funny. And I bet you also learn it's extremely tiring to talk
Very
to read
tiring,
your own book out loud.
very
I
tiring. It's
once
exhausting.
I once has had this terrible idea, which was to record myself reading annual reports. I know it's terrible idea. And first of all, an annual report is much like it's very boring. Let's admit it. And second of all, it's like at least 1 hour read, right? So you have to read all of, and it was like I was halfway through and I quit. I couldn't do it. It was just too much.
I'm not surprised.
Yeah. So I coming back to like the fund management side of things, I really wanted to ask you whether you think that having clients as a fund manager hurts or helps returns.
I think it's very important to have clients who know what you're doing, who
Mm-hmm.
know what they should expect, and who therefore are not going to be surprised, who they take a decision which requires enormous trust, and they've got to live with that decision. When I am on the other side of the fence, because I'm on investment committees that choose managers,
Yes.
and I place trust in the managers that we choose, it takes an awful lot to disturb me from to put me off course. It takes an awful lot to make me think that we should change a manager. I think you want to spend a lot of time as a client on making sure that you do really trust the manager. You know what they're going to do, you like what they're going to do, and you know that it won't always go right. And in fact, you can be completely confident it will go wrong at some stage. And you've got to see yourself through that phase. There's some very interesting statistics about changing managers. And one of them is, and I'll forget the exact figures, but managers fired outperform managers hired by something like 2% a year for the succeeding 3 years. And that's because most investors, most investment committees particularly, have a habit of looking at the very short-term performance and reacting to it. And so there are so many managers who are fired after 3 or 4 years of bad performance, just before they're about to have a period of good performance. And there are so many managers who are hired after 4 or 5 years of good performance, just before they peaked. So that's a tremendous discipline. I believe that an investment committee that is sensible is provided an opportunity by all those who are not sensible, and you can get it right by avoiding those short-termist temptations. But you asked a different question, which is, what is it like from the manager's point of view, having clients? Having clients who understand you, who trust you, and are supportive is a great booster. Having clients who don't understand you will tend to be a disaster and bad for returns. Very early in my firm's existence, we were approached by a very well-known name who wanted to give us some money to manage. But I knew about this particular guy, and he wanted weekly performance figures. And I said, I don't look at performance weekly. It's available, but I don't look at it. I look at it once a month. And I don't want to be looking at performance more frequently just because a client is looking at performance more frequently. So we should not take on your money. And I'm very glad we didn't, because I think it was just before the 2007, 8, 9 global financial crisis. And he would have been on the phone all the time saying, what's happened in the last hour? And why do you own this? Why do you own Tesco or whatever it was? And that is not conducive to good management. Investment management is a sort of fragile business where you can be pushed off course by sort of negativity. You need to try to preserve your objectivity. And if you have people who are on at you all the time about something that is going wrong, that's not helpful. And you can become too complacent about things which are going right by a sort of reinforcement, by meeting people who say how great it is that they've got the same thing. So the answer, I think, the right client base is a very good thing. And of course, you do need clients to make the fees and make money out.
Makes sense. So my last question actually applies Charlie Munger's principle of inversion, and is, if our roles were reversed in this conversation, what question would you be asking yourself?
I think I would want. I think I'd be interested in whether I saw things. And well, you asked earlier what I'd learned, and I gave a pretty feeble answer, which is that it's all incremental. But I think I'd want to know more about the differences between markets now and markets 40, 50 years ago when I first got a job. That's what I'd be interested in. What are the differences?
So
What are the differences? What are the similarities?
Yeah, so maybe you can tell us about that.
Well, I think that I had the great advantage of starting at a time when interest rates were 14 or 15% in the US and the UK, and inflation was very high. And the average PE multiple on markets was well below 10. And I think that's been a help in two things. One, the multiple side has been a benchmark throughout my investing life, so that I look for PE multiples which are 10 or so, or 10 or less. But that's one side of things. It's helped me to be a value investor, that when I started, it was very much a market in which there was enormous value. And the second is that I am just sort of more strongly aware than very much younger people, that the norm in terms of interest rates is not what we've had for the last 15 years. Last 15 years, we've had virtually zero interest rates and negative real interest rates below the rate of inflation. And it's become almost expected that that world will continue, but it's not a normal world. The normal world was what I saw in the first 35 years of my investing life, which is where bonds give you a real return of 2% or so. Equities give you something more than that. And even cash gives you a small return over the rate of inflation. And I think that is, so I think that's a help in looking at markets now, because I think we've returned to normal times. And if you were a Martian and you looked at the world's bond markets now, you would say, well, they seem to make sense, really. The UK has the worst yield. Well, the UK is always worse, so that makes sense. Then you have France, that's usually second. US, and then you have the US, and then at the bottom you have Germany and Japan. Germany is much more fiscally conservative, that makes sense. Japan, not so fiscally conservative, but very low bond yields. And you would say, well, this looks perfectly normal. There's a real return from each of these bond markets. That's all fine. You'd be slightly misled, because I think it gives you the impression there's a stable equilibrium, and I don't think it is at all stable because of the degree of government debt. But at least you would accept as a Martian that real yields were roughly where they should be. Whereas I think if you've been just around for the last 10 years or so, it's quite difficult to adapt to this return to the old level of real yields. And that, anyway, this is a much longer answer to your question, and it's a digression from your question. But I think that's the great opportunity now. We've had the conditions in terms of relative valuations for quite some time in place. We've had the conditions in terms of interest rates at this level in place. But what we haven't had until the beginning of this year is a catalyst. And I think we've had a catalyst in the volatility of US policy. Not whether it's right or wrong, or whether it turns out well or badly, but just the fact that it's so changeable. Tariffs have popped up and down all over the place. And that, I think, has changed the name of the game. It means that US investors who've been completely loaded up on the US, which has been the only game in town for all these years, they've begun to look around the world and look at places where they find that there are stocks which are languishing on relatively attractive valuations. So that, anyway, that's the great excitement of being back, of being active in the business again at the age of 70.
Isn't it crazy that 80% of you aren't subscribed? So if you made it this far, here's my promise. Follow or subscribe for free, and my team and I will make every episode 1% better. Check out the last episode too if you enjoyed this one, and thank you so much for listening.